All right, our next guest says the current market structure is broken and retail traders are getting a raw deal. Let's bring in Dave Lauer. He's a former high-frequency trader at Citadel. He is now CEO of Irvin AI. Dave, great to have you with us.
Thank you so much, Melissa, for having me on. It's a real treat.
Why a raw deal? What about the deal is raw?
I think there's a lot about our current market structure that's overly complex. And if you ask any regulator, they will tell you that this is not the market structure you would design if you were starting from scratch. And it's something that's been layered on year after year and decade after decade. And frankly, the point that we've gotten to is one in which a lot of incumbents have been able to structure it exactly how they want it to be structured because they're making a lot of money and they are able to wield a lot of political power. And I think we've really lost sight of the two primary purposes for markets, which is price discovery and capital formation. And price discovery is so critical that happens mainly on stock exchanges, on lit markets. So this issue that you just brought up with half of all trading taking place off of exchange and up 70% or more in stocks like GameStop and AMC, I think is a real problem, and it's costing everyone money. It's costing the retail investors money who are trading through their brokers and all of whom's orders are being sent to people like Citadel and Virtu, but it's costing pension plans and mutual funds money because they're the ones trading off of the exchange quote. And if that quote is wider because of all this off-exchange trading taking place, and by some estimates, 25% or more is how much wider the spread is than if all of those retail orders were to make it to the exchange. So if they're trading against a wider spread that's 25% too wide or artificially widened, that's costing pension plans money. That's costing mutual fund companies money. That's where retail truly has all of its wealth. And I think that's a big problem.
So they're getting a raw deal because they have to pay more under this current antiquated system that was built by incumbents, you say?
Yeah, that's right. And when you have the internalizers in a de facto duopoly, you have other issues around corporate concentration of power and antitrust. And Gary Gensler has said exactly that in his SEC testimony, or in his congressional testimony when he was becoming the SEC chair, and in his first testimony. You know, this is an issue that I think is going to get a lot of attention, and I think that concentration of information is also problematic, right? If 70% of GameStop is trading through Citadel and Virtu, and they're also making markets on exchange, and they're the designated market maker on the NYSE, for example, they have a huge information advantage. And that kind of information advantage means that they have a lot of power to set the price of that stock. Now, it doesn't mean that they're affirmatively manipulating it. I'm not saying that, but it does mean that they have a lot of power and they can swing it, in all sorts of ways to help improve their profitability or change the quote at which they're then internalizing.
Hey, David, it's Jeff Mills here. Quick question for you. Obviously the SEC regulation cycle is very long. We're shining a light here on some issues that impact retail traders. Is there anything that they can actually do today to better position themselves for the environment in which they're operating?
You're asking in terms of what should regulators be doing?
What retail traders can do right now? Like, are there any actionable insights that they can take away from this discussion other than the idea that, yes, they are disadvantaged, but is there anything they can do to better position themselves given the present circumstances?
I think so. And I think that they can take a good, long, hard look at their broker. And how does their broker handle their orders? Now, if you're a retail trader, it is very difficult to get away from a broker who is sending their orders to this duopoly of internalizers. However, when the retail broker sends their order to an internalizer, the internalizer has a certain amount of profit that they're going to make, and then they have a certain amount of money that they can rebate back to either the broker or the retail client. So if they send it back to the broker, that's payment for order flow. If they send it back to the client, that's price improvement. They get a better price on their execution. Some brokers take nearly all of it as payment for order flow. Other brokers don't take any payment for order flow. They just give it all back to their client as price improvement. So if you're a retail investor, you can say, well, I probably want to go with the broker who gives me everything in price improvement. That's going to add up over time. And it does get to another issue that I think regulators need to address, which is best execution. And are these retail investors really getting best execution if You're measuring it against an artificially widened spread, and it's okay for some brokers to take everything in payment while others are giving everything in price improvement. I can't see how those things can possibly both be best execution. But the problem is, if you ask a regulator, they will tell you, and this is a direct quote, that trying to enforce best execution is like trying to nail Jell-O to a wall. And I think that's a real problem for markets.
Yeah, I'm not a big fan of Jell-O, really never have been. But what I'll say is, it's interesting, we're drilling down on one very specific thing, but would you submit that the playing field in terms of where we were 10 years ago to where we are now in terms of the retail has never been narrower? My sense is the playing field has never been flatter than it is now, your comments notwithstanding.
Yeah, if you're going to compare to early days of Reg NMS or pre-NMS, there's no doubt that the electronification of markets has been an incredible trend for everybody, both the institutional asset managers holding money, holding the wealth of retail, as well as individual retail investors. I would never deny such a thing. But I think if you're looking to assign reasons for that, it's hard to say that the increase of off-exchange trading is helping, or it's hard to say that the practice of internalization is helping relative to something like decimalization, which dramatically brought down costs for people without all of this complexity that we've then introduced.
Last question, Dave, and that is, since you worked at Citadel and you have comments about what you call this duopoly running off-exchange trading of Virtu and Citadel, do you think that they use what they see in terms of order flow to their advantage?
That seems like a dangerous question to answer. And so I would never say, I would never accuse anybody specifically of manipulating markets or anything like that. But I think that having that kind of information is suboptimal for markets. Having that concentration of information is not where we want to be. I believe in open and free competition for order flow. And I believe if you send all of those retail orders to lit exchanges, you would compress spreads for everybody. And those retail orders would get just as good, if not better, execution because of competition, which is something that if you're in markets, you'd think you would support, just completely free and open competition.
Dave, great to speak with you. Thank you.
Thank you for having me. I appreciate it.
Dave Lauer. All right. Dan, what do you think? Because payment for order flow helped the retail investor get to $0 trading.
Yeah,
so
that's Robinhood, that's robo advisors.
Of that model.
I don't know who's complaining about what. I mean, they only complained when Robinhood shut them down and didn't let them trade, but they were perfectly happy to have a free iPhone app that let them trade all day and night and give them margin to do it. So, at the end of the day, it was the on-ramp for a lot of them. And are they complaining about payment for order flow? Are they complaining about being the product, you know what I mean? Not the actual service, that sort of thing? I don't think so anymore. And I suspect a lot of them have gone back to Robinhood because they're perfectly happy for it when it's open for business, right? So, and I just say one other thing that Guy made a great point is like markets have probably never been as transparent. You can talk about all this off-exchange sort of volume. It's always been that way. Tim, you remember trading on the buy. You'd go up in a big trade and it didn't print for hours.
Sure. It traded in pluses.
So it's liquid and it's transparent and it's easy.
The muni market was another example of very limited information.
The biggest market in the world.
But I will push back and say, back then you could have said that's the way it is. And then just say, okay, let's let it be. But that wasn't the answer either. We are in an information age of everything electronified, so why not have more transparency in this market? Jeff Mills, for you, the notion that that spread is wide between lit markets and off-exchange, to you, should that be rectified? Should it be a tighter spread? Should everything be going to a lit market?
Yeah, I mean, first of all, I think there's a misconception that people like me actually want some sort of rigged system because, we're big money managers, we manage billions of dollars, but like generally we are slower moving long-term investors. We're not trading in dark pools, things of that nature. So I think a lot of these big money managers, quote unquote, actually have interests that are very much aligned with the retail investor. So I think anything that can be done to improve liquidity, improve price discovery, I'm certainly supportive of that.
Shepard Smith here. Thanks for watching CNBC on YouTube.